James Coursier achieved financial freedom and retired at age 34 using property investing. But in this episode of this 4-part series, James is going to go and look at, is property the best way to retire early? The for and the against. Cool. Okay, to start us off, who shouldn't invest in property?
Oh, geez, there's so many reasons you shouldn't invest in property. One is that, it takes work. You've got to learn how to do it, right? And then once you decide you want to buy a property, you've got to find the property, you've got to negotiate it. You've got to go through the process of buying it. That could take up to 6 months, right? Okay, now you got this property. Well, if you decide you want that money back, it's a long process to sell that. You can't just press a button like on the stock market and just get your money back. There's big money involved, right? So for most people, unless you really know what you're doing, you shouldn't be buying a property for anything less than £100,000. A good approximation is you need about a third of what a property costs to be able to buy a property. And the reason is because the industry standard is a mortgage of 75% of the purchase price. And when you factor in all the transaction costs, then essentially it's about a third. So on a £100,000 property, it's what, like £35,000? That's a lot of money. A lot of people don't have that, right? So first, got to build that money up to then even just buy your first property, right? So what are you going to do before then? You've got to find something else. And then let's say you bought that property. Well, then you need another £35,000 minimum to buy that next property. So it can take time to do that. There's long periods of time between when you can buy a property. And then let's say you build up your £35,000, you buy your first property. Woohoo, exciting. Now, all your money is just in this one type of investment, and within this investment type of property, in one property. So if something goes wrong, all your money is just in that one property. So it can feel scary. It can feel risky, right? So you really need to make sure you're doing it right so that when you do that, that is a good investment. So, and then let's say, you get to retirement, you've got all your properties, it's making you money, and then you chill out. Okay, well, it's going to take you a bit of work. You've got to make sure it's managed well. There's going to be some maintenance stuff. You've got to do a bit of work. Don't get me wrong. If you buy the right properties, it isn't that much work, but it is some work. So if you really want no effort, then property isn't for you. But I will say this, a lot of the perceived risks and issues around properties are actually benefits, but it's about how you reframe them and how you understand property and how you use it to your advantage.
That's really interesting. Could we hone in on that around the risks versus benefits of property?
Yeah, so let's take an example, right, of leverage. So the mortgage, the debt. So many people just like get their back up when they think about debt. Debt is bad, it's risky, right? Yeah, that's true, right? So let's say you buy £100,000 property and £75,000 of that is a mortgage from a company, okay? What happens if it goes down in value? Let's say it goes down by, say, 35%. That means the value has gone below the money that you've borrowed. So you're actually in a negative position. You now owe the money to the bank more than the value of that property. So if you had to sell that, you'd actually have to pay them more money. Really scary. And because you borrowed money, a small reduction in the value of the property could mean an even bigger reduction in how much money you're losing versus how much money you've put in. So that's true. But if you think about it on the flip side, when you invest in property, right, because you've got leverage, let's say you put in £35,000 on a property, and let's say that property goes up by 10%. So it goes from £100,000 to £110,000. You've put in 35,000 and it's gone up by 10,000. So you've gone from 35 to 45. And that is around a third increase. So about 35% increase. So your 10% improvement in the property price has meant that you've gone up by 30 to 35% in the amount of money you've put in.
This is massive. And I think, from my personal perspective, is the number one most misunderstood thing about investing in property.
100%, right? I hear this all the time, and I've been interviewed lots of times, and this comes up mostly with people who are like default around stock investing, because they keep trotting out this whole thing of, if you look back, property has underperformed other asset classes, and especially the stock market. So why would you invest in property when you can invest in the stock market with basically no effort and make better money? Fundamentally incorrect. And that is because of leverage in property. The vast majority of people will not use leverage in the stock market because it is way more risky. So think about it. You can go to a bank and you can borrow 75% of the value of a property for hardly anything. The interest rates are very, very low. Why is the interest rate so low? Because the lender views that loan as very, very safe. They're a professional organization and they view it as very safe. Why? Because it is safe. There is a process when you go through purchasing where you have a legal process, there is a valuation, a formal surveyor goes out and assesses that property, assesses the risk of that property. They assess the value. And so they report back to the lender to tell them this is a safe investment. And so, yes, property can go down in value, but the vast majority of time, property goes up in value. Let's just look at the last few years. When COVID happened, everyone's like, oh no, property's going to do awful. It's going to crash. It's going to crash. The world's going to end. Did it? No, it went up in value enormously. Again, after the mini budget fiasco and everything going crazy and interest rates having to go up and so on. Again, people said that the property market was going to crash and go crazy. Yes, it went down in value, but very, very little. In the last year, the UK property market has gone up by around 5%. The year before, it went down by around 5%. With all of that drama, it went down by 5%. And then with another year, it just regained that increase. Why? Because there's a lot of fundamentals to property that protects it, that makes it a very reliable, safe way to invest. It creates a lot of like protective mechanisms within the fundamentals of property that allow it to produce strong returns reliably and safely. And that is why you can borrow so cheaply from so many lenders. There's hundreds of lenders out there that will lend to you, including reputable high street lenders like Lloyds and HSBC and Halifax and Nationwide.
So then if someone were to challenge that and take the extreme example of the 2007, 2008 financial crisis, where, the core of it was around property and mortgage lending, what would you say to someone who would look at that and say, well, actually, property could be seen as risky and could have these dramatic shifts?
So when you look back on statistics, it's so tempting to go to the very top and the very bottom, analyze that and say, oh, that's awful. But in reality, when you go back to the last crash, which was around 2007, 2008, the drop was around 20%. Okay, that's a lot, but it's not that much. Remember, what was the stock market crash at the time? 50%. Also, when you're looking at it, you're looking at the very extremes. You've got to be extremely unlucky to have bought your property or properties at the very peak of that market. And then to sell them at the very bottom? That almost never happened. The reality is you're buying regularly throughout the market and you're buying at various points. Usually within a cycle, it's only the last couple of years before a property crash that is a bad time to invest. And even then, if you give it long enough, in time, it will just feel like a blip in a very long progression upwards within the property market and the growth of prices within the property market. And that's because, again, there's fundamentals as to why property go up. People always need a place to live. And especially if you're buying somewhere that's geographically restricted, somewhere popular, and there's only so many houses that can be built, in time, as population improves, the economy improves, the value of the land improves, property will go up in value. In addition, what you got to remember is property is an inflationary asset. What that means is it will go up at least in line with inflation in the long run, right? And that's because a lot of the reason why property is going up in value is because the pound or the dollar is going down in value, right? So let's say you have £100,000 today, okay? And then you fast forward 10 years and that £100,000 obviously isn't going to be worth the same in 10 years time, okay? So let's say you need £200,000 in 10 years, right? To be able to buy the same amount of goods and services, right? Because the price of bread and milk and cars and everything go up in value, right? Go up in price. Well, same thing with property. Property is going up in value simply in part because the value of your pounds or dollars that you're using to buy the property are just worth less. Because of leverage, because you're borrowing against the property, you make money. And this is super important to understand, and most people don't understand. You are making money simply on inflation. Okay. So let's just say property went up in 5 years by 15%, okay? Just from inflation, just because the value of the money is now worth less, okay? So it hasn't actually gone up in real terms. It's just gone up because you have to spend more pounds to buy it. But because you've borrowed against the property, that 15% increase is more like 45 or 60% increase on the money you put in. All right. Now, this can get a bit confusing for people, but essentially it just means that because you're not putting all the money down, all right, just inflation is making you money. And so generally speaking, again, it changes year to year, but when you look back over the long, long run, many, many decades, let's say the last 100 years, property broadly has gone up it's doubled every 10 years, which is roughly about 7% a year. Is that consistent? No, but roughly. So if you take, say, 7%, with that leverage, let's triple it, say, that's a 21% annual increase in your returns. Then you've got the rental income, okay? And even if you buy vanilla buy-to-lets, right, you can very easily get a 5% profit on the money that you've put in just from the rental income.
When you say very easily, how much of that, particularly in the UK property market, is dependent on the area that you buy and the point at which that area is going through its property cycle?
So obviously, the more you understand, the more you experience, you're going to be able to do more and more clever things to make more money. But early on, when you're not really sure what you're doing, the easiest thing to do is just buy in areas that have historically have a very long track record of doing well. If you buy in the center of London or the center of Manchester or Birmingham or Liverpool or Nottingham, a good quality city where people want to live, they've wanted to live there for decades. It's in the center, so it's geographically restricted in a good part of that city or a good part of that, either in the very city center or you know how parts of a city where like people like to live and have always liked to live there because of the fundamentals there. That place will always do well because people will always want to live there, right? It's not like somehow something that's going to completely change. And so if you buy something like that, people are always going to want to live there. They're always going to want to rent there. And so the rent that you typically can expect on a property, if you look and you look carefully, you can expect around 5% profit. Now that can vary higher or lower for a number of reasons. The main thing is its capital appreciation potential. So this is one of the things you got to understand. So there's two ways you make money from property: rental income and the property going up in value.
Which is the phrase that you just described.
Capital appreciation, yeah. So a complicated way of saying it going up in value, because the capital, which is the value, appreciate just means increasing. So, but in property, most of the money is actually made through the value of the property going up. Okay. But most people make the mistake of pushing for rental income because it's reliable and they can feel it and they can see it coming in. The problem is when you pursue a property deal, you know, if a property has more rental income, then the capital, the money you're going to make from it going up in value will be less, or vice versa. And that's because obviously, if that wasn't the case, right, why would you buy a property with low rental income, right, versus something with a high rental income when the capital appreciation is the same? You wouldn't, right? What would then happen is they adjust to make them equitable, to make them similar in the expected return.
It's interesting because this, in some ways, reflects a similar, although not exact, dynamic of the difference between value stocks and growth stocks that you mentioned in the last video. Similar, not the same, but similar.
Yes, exactly. And similar in that different times of the market, different places, one is more important than the other, right? So, but just like the stock market, one of the reasons why you get such a high return from the stock market is because it's so messy and volatile. And that means that people get scared and they don't tend to invest in it. So then if you're willing to invest in it, you get a much better return. So take it to the stock property market. If you're willing to buy something that has high expected increase in values in the future, so capital appreciation, you're going to make more money on that than you are from rental income because it's not as reliable, right? Because much more people are pushing for the rental income over the capital appreciation.
Okay, so a lot of people will be listening to what you're saying and thinking, okay, this all sounds great, but they might be already a property owner living in their home and they're not seeing the benefits that you're talking about.
This is all to do with property investing. This is about becoming financially free by making money, saving it, investing that money and making money from your money, and getting that to a point where the money you're making from your money means you don't need to actively work, right? That's what I'm talking about. Owning your own home is mainly for the purpose of having security and safety and comfort in where you're living and longevity there, right? Like that's the main reason. There's this whole debate as to whether your own home is actually an investment. Is it an asset? You know, is it positive from the perspective of an investment place? Or is it the opposite, what we call a liability? Is it costing you money? And it depends. I would say for a lot of people, it can be a liability, even though they think it's an investment because their home is going up in value and it's worth so much, right? And they're saving on the rent. This is why everyone says, oh, I'm saving on the rent, right? And anyone who doesn't own a home, oh, the rent. But there's so many reasons why owning your own home can actually be costly. One, because when you go to buy your own home, you end up buying a home way bigger than you would have bought or lived in if you were renting, right? Because, oh, I need a house for like 10, 20, 30 years. Or what if I have kids, right? Oh, I want a spare bedroom. I want a really nice place. So we end up stretching ourselves when we own our own home. Secondly, once you bought the home and you moved in, you start to nest. Oh, I want a cute kitchen. I want a cute living room. I want to get a new sofa. You spend an enormous amount of money in our own home. If you rent, you don't do that because it's not your home. Now, that's not to say you shouldn't do that, and that's not a good idea, but just acknowledge that all of these things mean that you end up spending more money. The more money you spend, the less money you're saving, the less money you're able to invest, and the harder and slower it's going to be to become financially free. When I bought my first home, it was absolutely investment because what I did was I was renting in London at the time. I found a friend and I convinced him to come together so we could buy our first home. I couldn't afford my own home at the time because it was London and they're so expensive. But what I did was I made sure we got a 3-bedroom property. So we had that third room, and then we Airbnb'd that third room while we were living there. And that money that came in paid a huge amount of the mortgage. And so what we were paying each month in bills and mortgage after the money that we were receiving from the person in the third room was way less than what I was paying each month in bills and rent before I owned my own home. And so factually, before I owned my own home compared to after, I'm spending less money on rent and bills, on living, and therefore I can save more money, I can invest more, and I can fast track my journey. So a really simple way to think about it is, am I spending more money now than when I was before I owned my own home? If I am, well, then it's costing you money. Yes, the value of your own home can go up, but unless you're utilizing that, unless you're getting that money, it doesn't really make a difference to you in a practical sense. The one thing you can do though is, let's say you buy a home and it's worth £200,000, and then a few years later it's now worth £300,000. You can remortgage your home, right, at the higher value. You get more money from the bank, and you can take that money and then you can use that money. And if you use that money and you invest it, and the returns you're getting from your investment is higher than the cost of that debt with the mortgage company, then you're making money. Interest rates are very low. Let's say you're paying 3%, 4% on your mortgage, but then you go and you make 10%, 15% in the market. Well, the difference is money you're making, and then you can grow your wealth even quicker. But the key here is, are you actually going to take that money and invest it and do it in a way where you're going to make more money? If you feel you're not going to do that, for most people, it's actually not for most people, for lots of people, it's better just to keep it in your own home, because it's forcing good financial discipline. Because every month they're making you pay your mortgage. A lot of that mortgage is paying off the debt. And so over time, you're reducing your debt and you're improving your position. But if you want to take this seriously and you want to speed it up, there's things you can do, like I've highlighted, to improve things.
Gotcha. Okay. So now taking a step back, fundamentally, why has property investing worked so well for you?
All right. So the reason I moved to property was because the stock market produces a really strong return, right? 14% the last 40 years, 10% over the last 100 years. I mean, they're really good numbers, and that's really long periods of time. The trouble with the stock market is it moves up and down a lot. Okay. It's not like a nice, neat increase. So two main issues for that. One is that can feel very scary, and it's very hard to stay in the market consistently, right? And it feels uncomfortable. And so you've got to make sure you follow through on that in a way that feels confident. The second thing is, because it's so volatile, the amount of money that you can take out each year to live on is actually way less than that, because you've got to factor in inflation, and you've got to factor in the fact that if you start taking out exactly what you think it's going to make each year, well, if it starts off doing worse, then you could very easily actually lose all your money, and then all of a sudden you'll start running out of money. So the going rate as to what most people agree on in the kind of financial world is you can safely take out 4% a year if you invest in the stock market. 4% isn't very much, right? So the nice, neat calculation is, if you multiply your monthly spending by 300, so let's say you want to spend £2,000 a month, well, you need £600,000 to retire and live off £2,000 a month. £600,000 is a lot of money, right? Okay. So it's going to take you a long time to build that up. Within property, because you can easily make 5% profit per year on rental income, and then you've got the capital appreciation. So let's just do a quick simple math. 7% on average increase in the property market with leverage is around 21%. But let's reduce that down to, say, 15%, factoring in inflation. Maybe you didn't quite get what you were expecting. 15% plus 5% is 20%, right? Now, 20% is way higher than like the 10 or 14% in the stock market. The other thing is the returns you make in the property market are much more reliable. The rental income much more reliable. The steady increase in the property market is much more consistent than the stock market. Yes, it goes through crashes, it goes through ups and downs like 2008. But again, the property market went down way less than the stock market and has had much less of those in the past compared to the stock market, which means you can take out or use much more of the expected returns from property investing compared to the stock market. So for someone just doing really basic vanilla, rather than being able to draw out, say, 4%, 10% is a very conservative amount that you can be able to rely on and take out. So let's do that again. Instead of multiplying it by 300 at a 10% drawdown rate, you only need to multiply your monthly cost of living by 120 to come up with the number that you need to retire. So again, £2,000 a month is what you need to retire on. You only need £240,000 to retire. So compare 600,000 to 240 is a big, big difference, right? So what that allows you to do is be able to retire earlier or be able to retire with way more wealth and way more spending ability. And the last thing about why property is so powerful is that you can put time and effort into it. And the more you do, the more money you can make. With the stock market, you just can't do that. So the vast, vast majority of people who try to time the market, pick stocks, do worse than the market. And that's for a whole load of reasons. And it's basically the way human psychology operates. And also because the amount of information that is known within the market, right? If you look at professional fund managers, the people that are trying to make money for people in picking stocks, almost all of them do not beat the market. In fact, it's so rare that the people that have been able to consistently do it, like Warren Buffett, like Ray Dalio, they are viewed in the industry as unicorns because it's so rare, it almost just doesn't exist. Okay. So the way to make money in the stock market is just by being in the market and making the market returns. Within property, okay, you learning, understanding it, finding a better deal, spending a bit more time looking at more deals, moving into a more complex thing like HMOs or service accommodation or doing a refurb. These things can increase the returns. Also, the cycle is much more reliable. So there's this 18-year cycle that plays out in property where you can much better understand generally where the property market is going to go. And by doing that, understand when to invest, when not to invest, and also where to invest. Okay. Because if you're seeing in the market that everyone's super scared, that's the best time to invest in property. When things are crazy and everyone's talking about it and you go to the hairdressers and they're trying to buy property and everyone's trying to give you money and everybody says it's never going to go down, then obviously that's the time when it's probably going to crash soon.
Gotcha. Okay, let's really jump into that because a lot of people will know nothing about the macroeconomics of this and the property cycle. So starting from the fundamentals and building it up in complexity, what is the property cycle and how does it work?
So over the last 100 years, and you can see this over and over again in the UK, in the US since essentially they gained independence, Australia as well. Most developed countries have it, and you can see it very clearly. And it's essentially where you've got 18 years and you have 2 7-year growth periods, a crash that then creates like a 4-year malaise, a 4-year kind of bad period, and then it starts again, right? And it roughly coincides with 3 short-term business cycles. Everybody knows about the short-term business cycles between 5 and 7 years. you have a going up and then a down, and going up and then a down. This is it's just part of like psychology, economics, the human dynamics, where people get carried away with themselves. They want to buy, thinking they want to kind of ride that wave. People buy, get excited, suddenly realize it's overvalued, and then it crashes, right?
The classic boom bust recession cycle.
Exactly. Essentially the same thing happens with the property market, but just over a longer period of time with its own unique properties. The first 7 years is good, solid growth, fairly slow and steady. Then you have what you call a mid-cycle wobble. So 1 to 2 years where it might go down or it kind of stay the same. And then you go through a second period that's even bigger and faster. That culminates into a bubble of a couple of years where it gets heady and everybody wants to invest. People suddenly realize it's overvalued. It crashes. Then you have about 4 years where it takes time for the market to regain confidence and want to buy property again. And then it starts again, essentially. And we are essentially in that second phase. It doesn't feel like that because everyone's moaning, but we are. So kind of COVID and around now, and that was the kind of mid-cycle wobble. We're coming into this bigger growth phase again. The only thing though is this time, the only thing that can stop the 18-year cycle is something that is so big that it kind of almost like resets the economics. And that happens just more generally as well.
Would COVID be included in that?
It's a question mark still. So the times when the property cycle reset outside of its normal process is during the world wars, okay? Because things were just so crazy and messy that things just couldn't operate normally. COVID was nothing like World War II, but it was big, it was massive, and also the reaction to it was huge. So can I sit here and say 100% this cycle will play out like the previous? No, I think it most likely still will. And I think the next few years will have really strong growth and we'll build back up to really strong growth and we'll have the usual crash again. But I think there is still a chance that actually this ended up being a bit of a reset and we'll almost start the cycle again. Okay. But I think it's important with these things not to get too stuck on it. Not too stuck on like, this is going to happen or it's not going to happen, right? Don't let it get in the way of the investing, because the most important thing is to invest your money and carry on and just kind of consistently building wealth, building income and like improving your financial situation. So like in reality, in both scenarios, you want to be investing, because if the cycle continues, then it's going to go up loads, you can make loads of money. If the cycle is reset, well, it's just going to go up by not as much. That's still fine. The only thing to catch about and just to be mindful of is if the cycle is continuing as expected, we will build up increasingly to a more feverish type of environment where everyone's convinced that property market's going to go forever up and do better and better and better. You're going to get fear of missing out, right? Everybody's going to want to start buying property. And when that starts to happen, that's when you need to take a pause, let things go crazy, let it just pass, and then start again when things calm down again. The best time to invest generally is when other people don't want to be investing. So I made most of my money in property during COVID because everyone was freaking out and said the property market was going to collapse. And I knew it was going to do well because there was no issue. It wasn't overvalued. It wasn't overheated. And so then when people realized actually it wasn't going to go up, that wasn't going to happen, the property market went up substantially and I made loads of money, right? The same again at the moment. Over the last year or two, I've been buying a lot of property because, again, people have been very negative around property. So it's a buyer's market. I can buy property way less than I was able to buy previously, especially in certain markets. Buy those. So then when things start to heat up again and do well, I've made a lot more money. So in summary, the cycle is about understanding the general principles, doing that in a way to encourage you to invest, not to discourage you. When people are freaking out and scared, that's the time to really invest. When things are doing well and good and decent, that's the time to just carry on investing and just keep plodding along and keep at it. When the market's crazy, that's when you need to either sell or stop buying. Last thing I'll say around the cycle is you also have this trickle down effect. So at the beginning of the cycle, people are wanting to buy the best types of properties. That's London, right? Or the outskirts of London, because that's like the highest value real estate within, say, the UK. It'll be the same for other countries. So that's where property prices go up first. As they go up, but everything else hasn't gone up, well, then money starts to move to the next best thing. So the outskirts of London, the southeast, Oxford, Cambridge, really high value areas, right? They start to go up, right? But then they start to become higher value compared to other areas. So then it moves to the next best thing. But
What sort of time periods would you say that it follows this?
it's more about just looking at where you are. So I'll tell you the process. I'll tell you where we are now. And so you can see it, right? And then it's less about like 3 years in it says 5 years in it this. It's just more like it just generally takes this process through the 18 years. So at the beginning, it starts with London, then outside to London, then it's the southeast, Oxford, Cambridge, then it's big next tier cities, Birmingham, Manchester, Liverpool, Nottingham. Then it's the next bigger city, next kind of large city. So Sheffield, Leeds, right? York. Then it's like Newcastle, that'd be the outskirts of those cities. And then all the way to just like smaller, remoter places. And right at the end of the cycle, you've got all the other stuff. And at the beginning of the cycle, you've got the stuff at the beginning of what I just mentioned. So at the moment, obviously London went up loads at the beginning of the cycle and hasn't done anything for the last few years. Southeast did really well at the beginning of the cycle. Now it's calmed down. Where we are now is Manchester, Birmingham, Liverpool. They're all doing really well. Birmingham all doing really well and have done for quite a few years. Will continue to do well. But then the next kind of like the slightly smaller cities are starting to do well now. Sheffield, Leeds, Newcastle, and so on, right? So like that's where we are. So if you want to play safe, you go for the big cities. You want to kind of catch the next moving trend. You want those slightly smaller cities. But even though that's what happens, you can't ignore fundamentals, right? You can't say, oh, well, Sheffield's going to be the next one. I'll just buy anything in Sheffield. You've got to buy good quality properties that people are going to want to live in, right? So, if it's Sheffield, it's a good quality, fairly new, nice property in the city centre of Sheffield or an area where people like to live, right? Because people are always going to want to live there. And you get better tenants and you get an easier life.
Gotcha. That's super interesting. And I think leads nicely into the next question, thinking about all the different trends and aspects and effectively, data points that you're talking about. How do you, or what are your recommendations of content/resources to consume for someone to at least stay abreast of the property cycle and to understand at what point we might be in it?
Okay, best resources. Well, the first thing is don't read the news, don't watch the news. Just don't go anywhere near the news for property advice. Most property related articles are not written by people who know what they're talking about and don't have good experience, and their interests aren't aligned. They're pushing eyes on their article, not on giving you good advice. So their focus is on making you scared, sensational information, and it's all very new, very just not important and often incorrect. So that's the first thing. The second thing is there's various resources where you can get the actual information. So Halifax, Nationwide, Home Track, they produce regular reports once a month at least, giving you an update on where the market is, what the past performance has been, what they expect the performance to be in the future. and you can actually see the numbers and see what is actually going on. You can start to understand like the reality of the situation, not what the news is telling you. Okay. Home track is really good because it gives you like city by city data, because if you just stay and invest in your own hometown, that's fine. You can benefit from the overarching potential and fundamentals of property. But if you want to make even more money, the best thing to do is think, where's the next best place to invest in for where we are? And like I told you, so right now, most of where I invest is in Liverpool. And that's because Liverpool is that like in that nice sweet spot where it's got international demand because it's famous for the Beatles and the football club. It's a tourist destination. It's big enough so that it will always do well as a city. It's a growing city where people want to live there and actively want to move there. But it's small enough so it's not those first tier cities. So it's still got a lot of growth potential. It's still like really undervalued compared to where it was in the last cycle. Whereas like places like London, obviously, is still really overvalued compared to that. So there's a lot of upward pressure and potential. So then you can like pick places that have that potential, and don't be too scared of investing somewhere where you don't live. I think a lot of people really struggle with this. My properties are all over the UK. I've got property in Scotland, in Wales, all over England. Might feel scary, but actually it's okay. It's just about building a team of people that you trust, right? At the end of the day, like if I want to get a place rented out, okay, well, it's the estate agent's got to rent it out. Like me going around and having a look, is that really relevant? It's the estate agent's got to go around and decide, is this in a good position to be able to rent out, because they want a property that is going to be straightforward and easy and no hassle. They're going to be able to find someone easily. They're going to be able to get a good tenant in there, right? They want an easy life. But obviously you want to be able to trust these people. So that's also how I've been able to do this while being remote. I live all over the world. I just came back from Bali and lived there for a while. I'm going to be living in Barcelona for a while. And that's okay, because even when I was in the UK, I didn't go and see these properties. I didn't manage them directly myself. And that also kind of frees me and takes the emotion out of it.
Yep.
Yeah. So in summary, right, if this is something you want to get into and you want to build resources to understand, don't watch the news. Read like trusted publications that actually tell you what's going on. Halifax, Nationwide, Home Track. Find people that inspire you and that you trust, that have got a proven track record of having achieved it and helping other people, and follow those people and understand and get their advice and understanding of like how you do it, the fundamentals, and also what's going on right now, and being able to make the most of that. You can find that on YouTube, on LinkedIn, various places. Let's take YouTube, right? The best thing to do is just watch various videos and see who you resonate with. But whoever you land on, just do some digging and just make sure, have they actually done it themselves? That's the important thing.
Gotcha. Okay. Super strong note to end on, and leads very nicely into our final video of the series, where James will be breaking down everything he's spoken about into an actionable strategy that someone watching could follow. And we'll follow 2 case studies, John Smith and Jane Doe, and different approaches, how fast or slow they could go on the journey towards financial freedom.